Hi, everyone. It's Melany Goodhue here, owner of Pulse Wealth Management, and I am joined for part two of our video series with Erica Vincelli, a mortgage strategist. Erica is an incredible mortgage agent who I refer many clients to, and I've had the pleasure of working with. Thank you so much for joining us again, Erica.
Always, always, always a pleasure.
If you missed part one of this series, go back a few days and check out that video. It's a good one. We talk all about refinancing. So, who it's good for, what the benefits are. And Erica shares with us a recent real life, pretty incredible life changing story. So, definitely tune into that if you missed it. Today, though, we are going to talk about rental cash damming. So, Erica, take the lead. What is it?
Well, rental cash damming is a very powerful strategy that uses the rental cash flows to make your principal mortgage tax deductible, makes it into a tax deductible machine.
Okay, great. And so who is this good for?
Well, rental cash damming, I'll actually explain a little bit of how it works. The way rental cash damming works is that if you own a rental property, instead of using the rental income to pay your rental expenses, we take the money on a little different journey, and we use, and it takes a bit of time to get your head around it because we have been kind of trained and coached to, separate rental from personal, business expenses from personal expenses. But when we receive rental income, it's ours. We can do whatever we want with it. We pay tax on it, so we declare it. So it's our income. So instead of using the rental income to pay the rental expenses, we do something different. We just take it in a different journey where you take the rental income and we apply it to our principal residence mortgage as a prepayment option. And typically, you have to have a mortgage with a line of credit that's readvanceable. And so, when you apply the payment to your principal mortgage, what happens is that amount of money becomes available on your line of credit. And
Mhm.
then you use the funds from your line of credit to pay the expenses for the rental property. And what happens in doing this is that slowly but surely you start using an investment or a debt to use as payments for expenses for the rental property. And by CRA rules, what happens is that when you use debt to invest with the intention of making money, that debt becomes tax deductible. So what we're slowly doing is typically our principal residence is not tax deductible because we don't generate an income from it. So what happens is what we're doing is gradually converting our principal residence to a tax deductible investment loan. And so there's obviously way more to talk about. This is not, people don't wrap their heads around this in a 5-10 minute interview or conversation. But that's kind of the gist of what happens. So rental income comes in, you pay down your principal mortgage, you readvance those same funds, and you pay your rental expenses with that. You repeat that every single month, and that's what rental cash damming is. And who this is good for is a landlord who owns at least one property and who has a mortgage on their principal residence, someone who maybe wants to be a landlord looking to come into building a real estate portfolio. So that would be, basically any landlord. It's really good for landlords who are in negative cash flow because we can use that line of credit to service any shortfalls. It's a huge advantage. It's good for, well, whether you're cash flow neutral, shortfall, or over, it doesn't matter. It's still good for everybody. It's good for anyone who wants to pay off their mortgage faster because with a property such as if you have a home, you can buy an investment property, implement rental cash damming, and then sell the investment property. And I've been able to see how this can help people be mortgage free in under 15 years on average. And it's quite frankly good for anyone who wants to pay less income tax. So I'm sure every single person across Canada, if not the planet, wants to pay less taxes. And this is a really great tax strategy for anybody that has a principal residence mortgage and that owns a rental property.
Okay, amazing. Thank you. So that covers who it's good for. Definitely some of those benefits. We all want to pay less tax. I would love to hear a recent real life client situation that you've helped implement this strategy for.
Yeah, well, I have quite a few actually, and I have to emphasize that it's not just, if you want this outcome, the journey to get there might change, right? So if somebody, for example, I don't know if I said that correctly, but for example, I had a client who was short over $1,000 every single month with their rental. We all know that rates went up over the last few years. And so a lot of people that bought an investment property in, 2020, 2021, and then with the rates having jumped the way they did, a lot of them went from a positive cash flow to a negative cash flow. Now, these clients, it was not their objective to have their house paid off. I mean, it's everybody in a way, it's mostly people's objective, but it wasn't their primary objective in this, with finding a solution here with rental cash damming. It was more about just not being in a deficit and paying out of pocket every single month. So in this strategy, what we did is their current mortgage for their principal residence was coming due. So we converted it to a lender that had a mortgage with a readvanceable line of credit. And now what we're doing is we're implementing rental cash damming, but we're also utilizing the shortfall with the line of credit. So every single month, if they're bringing in, let's just use some round numbers, they're bringing in $2,000 for rent, but their expenses are $3,000. Now they have enough room on their line of credit, like they have extra available funds. So what we did is they're bringing in the $2,000, they're paying down their principal balance by $2,000, but then they're taking off $3,000 of the line of credit and paying the expenses. So this is a short-term solution because as things, everything's fluid, things change and goals change and objectives change. But right now, they just don't want to be $1,000 in the hole every single month. So what this allowed them to do is wait for their rental property mortgage to come due, right? That one's coming due later on, so we can rejig that one later on. It doesn't really have anything to do with the rental cash out. It's mostly about your principal residence and the cash flow. But they have a good rate on the it has to do more with the rental income and the principal residence as opposed to the rental property. So right now, with the current mortgage as is, with the shortfall, they're going to save about $12,000 a year, which is being used by the line of credit. And because the line of credit becomes an investment debt for the rental property, then all that money is tax deductible. So they're actually going to be getting some of that money back at tax time as well. So it's a really great solution. But their objective was not to have a principal mortgage paid off. It was just to eliminate the cash flow. Because and I'm just going to continue, sorry, talking a lot, but there's so much to talk about when it comes to
Yeah,
mortgages.
yeah, for sure.
Another client had, their objective was to be mortgage free. And they were at the point where they were ready to sell their current property. And I said, well, why don't you keep your current property as a rental property? Take the equity out of that. We talked about refinancing, in the other segment. So they refinanced, took out as much equity as possible, and they bought a new property for themselves and converted their existing to a rental. Now, their objective is not to be landlords for very long, but we found a good property manager. They had enough equity to buy a new property. They're implementing the rental cash damming. And even with a very small shortfall every single month, like the previous example, they're actually going to be mortgage free in just around 14 years. So they had no money out of pocket to buy the rental property because it was all done through the equity that they already earned. And they had no shortfall, no out of pocket in the rental, with the rental income because they had the line of credit to service any shortfall. And if they implement it and do, as prescribed, they're going to be completely mortgage free in 14 years, which is half the time because they were going to be entering into a 30-year amortization mortgage anyways. So they are just hugely excited about this. This is saving them over $500,000 in mortgage payments by paying off their mortgage in half the time. It's actually more, but it's quite a substantial amount of money. So
Now,
those
the
are
primary
two.
residence would be paid off, but there'd still be this line of credit, right? That would be for because you're paying down the primary residence, but then the house is paid off, yes, but then there's still a lock balance, right?
Oh, I didn't explain that. I'm sorry. So when they sell the rental property after 14 years, because
Yeah.
their objective is not to be landlords, their objective is to be mortgage free. So yes, they do, they pay down their mortgage and they have a line of credit. And if they continue making those payments after the mortgage term portion is paid off, they continue making their mortgage payments, which pays down the line of credit. But at year 14, they sell the rental property and they pay everything off. So they
Mm,
actually have like the line of credit is paid off, the term mortgage is obviously it's not there anymore. So they are completely mortgage free.
that's
Now,
great.
what you
And then that's two properties paid off versus prior to that strategy with just the primary residence. When was that set to be paid off?
If they decided to keep the rental property and continue paying down the line of credit to the zero balance, it would have taken them about 23 years. So it still would have knocked off 7 years of mortgage payments.
Mm-hmm.
But they really said like their long-term goal is not. I believe their long-term goal is going to change, and this is why things, we check in every year to make sure, are you on track? Have things changed? Goals, needs, wants, what has changed? I suspect that the rental cash damming is going to go so well that they might want to leverage and buy another property. They have young kids, right? And so even though they were a little nervous about taking on what they called additional debt, where I said we're taking on additional assets, they also have two young children. And so what you can do in 14 years when your child is now ready to go to university or maybe, wanting to buy a home, they can keep this property, the rental property, keep leveraging it and use it for child's education. They can use it to help their kids buy a property because in 20 years, I mean, it's very not unaffordable, but it's very difficult. People are getting a lot of help to buy homes now, whether it's co-signing, large gifts, gifted equity, et cetera, et cetera. So, what is it going to be like in 10, 20 years? So owning rental properties now at today's prices will also help you help your kids later on with education or buying properties. So I suspect they're going to want to buy another rental. I just have the feeling. But if not, they can either keep their existing and be completely mortgage free, everything, the line of credit, everything after 23 years, or they can sell the rental and then not have that home anymore, not have that property in their portfolio, but the proceeds from the sale can pay off the balance of their mortgage.
Awesome. And then let's say no rental cash damming existed. So like pre you coming in and they just had their primary residence. Is that right?
Mhm.
Um, when would that have been paid off? Like what was the original amortization before you stepped in that they were going to
Well, they
be
would
mortgage
have,
free?
yeah, no, it's a good question because like, we were doing the mortgage anyways, right? They were planning on selling, they wanted to sell their house because they also just said, we just assumed that's what you do. We didn't really know there were other options. And I mean, I'm sure you hear that all the time in your business. I didn't
Mm-hmm.
even know I could do that. It's like the famous line, I didn't even know. So having somebody like you and myself, we can share strategies that people don't know exist and don't know that they're, subject to, that they can do for themselves. So originally they were going to sell their house, take the equity, and buy a new property. Given the landscape with rates and
Mm-hmm.
their budget, they were still going to be at a 30-year amortization.
Mm-hmm.
Now, obviously, with coaching and with the strategies that I know, aside from rental cash damming being one of them, I would have had them probably having their house paid off at least 5 years earlier
Mm-hmm.
with other strategies.
Right.
So, accelerated by weekly, topping up the mortgage payment,
Yeah.
but we can still do that with rental cash damming because the rental cash damming just kind of the calculation I use just uses a monthly payment. So if you
Mm-hmm.
actually do accelerated biweekly, you're going to knock off more years.
Mm-hmm.
So let's say originally they would have been at 30 years. We would have probably knocked that down to 25, but because one of the benefits of rental cash damming is converting your property, your primary mortgage to a tax deductible loan, they're paying their current mortgage with after tax dollars with no tax benefit. By implementing the rental cash damming, they actually were putting in, if they sold the property, if they sold the rental, they were going to put $80,000 less. They were going to pay $80,000 less income tax. So it's $80,000 over 14 years that they would have kept in their pocket versus paying the government. If they don't sell the rental property and they keep it and they just do the rental cash damming for the 23 years, they were going to put $140,000 of money back in their pocket instead of the government's. So if they were to do nothing and not rental cash dam, that's fine. It's not for everybody, and I understand that. But from a tax perspective alone, for tax purposes alone, I would consider this as an option for somebody that owns or wants to own a rental property because that has huge value. They wouldn't have had any of that tax benefit. They wouldn't have saved that much money in that amount of time without implementing rental cash damming.
That's great. Now, I know we're going to wrap up here in a second, but I want to go back to first case study, if you don't mind, because I'm sure when people were listening to our conversation, they're going to wonder. So you had said that, if this couple, they were $1,000 in the hole every month. So you did rental cash damming, solve that. So now they're not paying it out of pocket. It's just being covered by the line of credit through this kind of flow through strategy, right? What's the difference or what's the benefit? Like, why wouldn't they just get a line of credit?
Yeah, it's a good question. Well, first, it might not be a large enough line of credit. I mean, this is a line of credit, right? This is just one secured to the house. And the purpose of this one is that it's readvanceable. So as you pay down the principal, you have access to those funds. So if
Mhm.
they just got a $20,000 line of credit
Right.
and we needed $1,000 a month for 3 years, there's not enough money to do that. Also, with certain lines of credit that aren't secured to the property, it might not be an interest only payment. So then your payment is actually higher. So in theory,
Mm.
yes, you could just have a line of credit, but one, is it the right the right amount? Is it the right type of repayment? And so I would want to make sure that that makes sense for somebody, right? Because the whole intention is that we're trying to minimize their payments. And by using it with a interest only payment, then the payment itself, you still have to pay something out of pocket, but because you have to pay the line of credit, but it's much, much lower
Yeah.
than $1,000. I've even done the math for these things for over, when was the last time I did the calculation? So I did 24 months. And I think it ended up costing them in the 24 months ended up costing them like $2,000 in interest payments versus the 24,000 that these people, this is not the same scenario. This is something
Yeah,
else
yeah,
I did
yeah.
the calculation for. So in that 24 months, instead of being short $1,000 out of pocket, your money, $24,000 of my money is a lot of money, versus paying the line of credit $2,000 in those 24 months. That's
Mhm.
good math for me. And then when it comes up, when you're at the end of your renewal, or you're coming up at the end of the term for your mortgage, well, then we can refinance and pay off that line of credit. Now, that may not apply for the rental cash damming. I'm kind of skipping to two different scenarios, but I would just want to make sure that the line of credit that you have doesn't cause friction with the implementation process of rental cash damming.
Amazing. Thank you, Erica. I really appreciate it. Thank you so much. I know rental cash damming is going to be a new concept for a lot of people watching this video. As you mentioned, we could talk about this for 3 hours and probably still have more information to
Love
share.
it.
So everyone know that this is not intended to be an all-inclusive video at all whatsoever.
Yeah.
And we've kind of just scratched the surface. And that is why I'm going to throw Erica's information in the description comments below. That way, if you want to learn more, you've got a rental property or you're thinking about expanding your portfolio into additional real estate and think that, oh, maybe this could be a good play for me. Erica is very open and honest. She will tell you if it is or isn't, and she offers that as a complimentary consult. So feel free to reach out. She's an open book and so lovely to work with. Thank you so much, Erica, for joining me. I really appreciate sharing your wealth and knowledge today.
Thank you. Bye.
Bye.